Right now, while you're watching this video, millions of Americans are quietly going broke. And here's the terrifying part. The government's own data proves it's happening, but almost nobody's talking about it. This isn't a prediction. It's already here. We're living through what economists call a silent crisis, not the dramatic kind with crashing stock markets or bank runs you see in movies. This is different. This is slow, methodical, almost invisible. But the signs are everywhere if you know where to look. Credit card debt just hit an all-time high of $1.13 trillion. That's trillion. With AT, personal savings rates have collapsed to levels we haven't seen since 2008. And here's the kicker. Over 60% of Americans are now living paycheck to paycheck, not just minimum wage workers. We're talking people making six figures. Something is fundamentally broken. Let me tell you about Sarah. She's a composite of thousands of real stories flooding financial advice forums right now. Sarah makes $75,000 a year. That's above the median household income in America. She should be comfortable, right? But here's her reality. Her rent increased 30% in 3 years. Her car insurance doubled. Groceries that used to cost $150 a week now cost $220. She hasn't changed her lifestyle. She's not living extravagantly. She's just living. Last year, she had $8,000 in savings. Today, less than $1,500. And Sarah keeps asking herself the same question millions of Americans are asking. I make decent money. Where is it all going? This is the invisible crisis. It doesn't announce itself with breaking news alerts. It creeps into your bank account month by month, purchase by purchase, until one day you realize you can't afford the life you had 3 years ago. Here's what they're not telling you. The official inflation rate, the government reports, that number is calculated using a formula that was changed multiple times since the 1980s. Each change made inflation appear lower than it actually is for everyday Americans. They call it hedonic adjustment and substitution. Fancy terms that basically mean if steak gets too expensive and you buy chicken instead, they count that as you maintaining the same standard of living. But you're not. You're compromising. And that compromise doesn't show up in the official numbers. Independent economists, using the old calculation methods, estimate real inflation for basic necessities has been running between 15 to 25% over the past 3 years, not the 3 to 9% you've been hearing about. That gap, that's your missing money. But here's the deeper truth that should concern everyone. This isn't accidental. This is the result of decades of policy decisions that prioritize certain economic metrics over the financial health of ordinary Americans. Let me break down what's actually happening to your money. Since 2020, the Federal Reserve created more dollars than existed in the entire previous decade. More money chasing the same goods equals inflation. Economics 101. But it gets worse. That new money didn't go to you. It went to banks, large corporations, and financial institutions first. They got to spend it before prices went up. By the time it trickled down to regular paychecks, prices had already adjusted upward. Economists call this the Cantillon Effect. Those closest to the money printer benefit most. Those furthest away workers, savers, people on fixed incomes get hit the hardest. Meanwhile, wages did go up. Headlines celebrated it. But here's the problem. Wages increased 20%, while the real cost of housing, food, energy, and healthcare increased 30 to 40%. You've got a raise. You're still falling behind. And assets. If you owned stocks or property, you probably did okay. Those inflated too. But if your wealth was stored in cash, savings, which is how most Americans save, you just watched your purchasing power evaporate. This creates a devastating cycle. The middle class is being hollowed out not by dramatic collapse, but by quiet erosion. Think about what this really means for people. Parents who saved for years to buy their kids' first car now can't afford one. Families who used to take a modest vacation every summer haven't left their state in 3 years. Young people who did everything right got the degree, got the jabbar living with roommates at 30 because homeownership feels like a fantasy. This isn't about buying luxury goods. This is about basic dignity and stability. And here's what makes it psychological torture. Everyone's pretending everything is fine. The stock market hits record highs. Unemployment looks good on paper. Politicians from both parties declare the economy is strong. So people suffer in silence, thinking it's their fault. They blame themselves for not budgeting better, not working harder, not being smarter with money. But you can't budget your way out of structural economic dysfunction. The crisis isn't in your spending habits. The crisis is in the system itself. And the most heartbreaking part, the people being hit hardest are the ones who played by all the rules. They worked hard, saved money, avoided debt when they could. They did everything America promised would lead to stability. Instead, they're watching that stability dissolve in slow motion. So why is this happening? And why isn't it being fixed? The uncomfortable truth is that our current economic system requires constant growth to function. When natural growth slows, central banks create artificial growth through money printing and low interest rates. This inflates asset prices, which makes wealthy people wealthier, at least on paper. It makes economic headlines look good. GDP goes up, markets go up, but it destroys the foundation of middle-class wealth, stable purchasing power, and savings. Here's the bigger problem. We're now trapped in this cycle. Government debt is over $34 trillion. That debt becomes harder to service if interest rates stay high. So there's enormous pressure to keep rates low and keep printing money. But keeping rates low fuels more inflation, which erodes purchasing power, which requires people to take on more debt, which makes them more financially fragile. We're not solving the problem. We're managing the decline. And every solution proposed more stimulus, more programs, more intervention requires more money creation, which makes the underlying problem worse. This isn't sustainable. Everyone in power knows it. But the incentives are to keep the game going as long as possible and hope there, not the ones in charge when it finally breaks. So what does this mean for you? First, understand this. You're not crazy and you're not failing. If you feel like your money doesn't go as far as it used to, you're right. The data backs you up. Second, recognize that traditional advice, just save more, just budget better, isn't enough. When the purchasing power of your savings is being systematically destroyed, the silent crisis is real. It's not common. It's here. And the scariest part? Most people won't realize what happened until it's too late. They'll wake up one day and wonder how they went from comfortable to struggling without ever making a major financial mistake. The crisis isn't loud. It's not dramatic. It's just relentless. And that's exactly what makes it so dangerous. The question isn't whether this affects you. It already does. The question is, what are you going to do about it?